Good. Today's topic of webinar is risk-based internal audit, and Mr. C.A. Bharat Garg sir will be the speaker for our today's webinar. Bharat sir is a chartered accountant and a company secretary with over 2 decades of extensive experience in internal audits, process and compliance reviews, investigation, risk management, and revenue assurance. He is also an internal auditor and is currently advancing his expertise by pursuing the CISA certification. Bharat Sir's professional journey spans the entire spectrum of consulting private and public sectors, having served in esteemed organizations such as Deloitte, PwC, Vodafone, RBS, and BSNL, among others. His career is marked by diverse exposure across various industries, including banking, financial services, telecommunications, manufacturing, and FMCG. Presently, Bharat Sir serves as a head of audit at Fidelity International in India. His commitment to the profession is further demonstrated through his active involvement with the Institute of Auditors, Internal Auditors, where he has held significant roles including immediate past president of Delhi chapter and board members of IIA India. Previously, Sir also chaired the IIA India Publication Committee in leading the publication of monthly digital magazine called Internal Audit Today for approximately 2 years. Now I request Bharat Sir to start with the today's session. Thank you, sir.
Okay. Good evening, everyone, and thank you, CA Priyanka, for the introduction. I hope everyone is keeping safe and healthy. I have been told that there are more than hundreds or 200 plus delegates who have joined, and it speaks a lot, about our members' zeal to learn and continuously strive towards continuous improvement. It's a Wednesday, and still so many delegates coming up to learn more about the topic. So that's great. I would also like to thank Board of Internal Audit and Management Accounting, CA Prakash Sharma ji, CA Preeti ji, and also Vice President of our institute, CA CJF Nanda ji, and our organizers, Aarti and Arunji, for giving me this opportunity and share my experience. So, our today's topic is risk-based internal audit. And before we delve into it, let me start it with a video first. Let me share my screen.
Sir, we found a way to eliminate risk entirely from our projects. Lead crystal, custom engineered. Name a project we're bidding.
McChesney Office Complex.
In February, we'll have a crane accident that shuts us down for 8 days.
Coopersmith.
We've got cost overruns in March from a global spike in steel prices. In April, credit markets freeze up. And we'll have 2 subcontractors going under.
Was this expensive?
A little.
We're gonna be rich. Did we have insurance on that?
Oh, look, it came with a stand.
हेलो
Hello.
हाय भरत जी स्टार्ट हो गया है आरती मैडम
Hi. Good evening, Preeti ji.
हाय हाय कैसे हैं हवारी भरत जी
All good, Preeti ji. Thank you for the opportunity. So we
My
just got
pleasure.
started, but I just played a video. But yeah, please.
Okay, okay. Dear participants, it's nice to have all of you in this webinar where Bharatji is a speaker, and this is a Board of Internal Audit and Management Accounting. And friends, risk-based internal audit now. Everything is risk nowadays, and the types of risk has been actually changing day in and day out because the new technology is in on daily basis, and accordingly the types of risk is also changing because the methods of uh, cyber what attacks are also changing, and hence the importance of internal audit, specifically the risk based internal audit, is very very important. And that's why we have thought ki let us have this topic, and who can take the best one other than Bharatji. And we invite you, Bharatji, over here. We have with us Priyanka Jadhav and Kinjal Mirani are the moderators for this session, and all my dear participants. Every Wednesday we are coming out with this series. Chairman of the board is here, Prakash Sharma, in his absentia, and our honorable president and vice president. And this is our endeavor to serve the best to all the members. And as a board of internal audit, what we can do best in this world and for the members, we are trying to do that and serving a lot by the way of webinars. Recently, we have also announced the result of certificate course of this concurrent audit, internal audits. Various activities are going on. We need your support and also suggestions for taking it further at newer heights so that we can do the best for the betterment of fraternity. With these words, I welcome all of you to this webinar, and let us spread the knowledge, and thank you very much. And over to Aarti Bansal, the secretary and entire team of our board, who is coordinating and the face of this board of internal. Thank you so much.
Thank you, ma'am,
Thank you, Preeti
for
ma'am.
your kind words. Thank you, ma'am, for your kind words and interacting with the participants for the today's webinar. Under your leadership, we are able to conduct many activities like certificate course on internal audit. We have announced the result of concurrent audit as well. And we are conducting the TMBF batch. Now I would like to hand over the mic to our today's speaker, CA Bharadwaj sir.
Thank you, CA Preeti ji. Thank you, CA Aarti ji. Okay, so dear delegates, I hope you all saw the video. And I really like this video by International Risk Management Institute. And towards the end, it highlighted two very powerful statements, which we all know, but yeah, they are very, very important. Risk cannot be eliminated, it can only be mitigated. Uh, as an internal auditors, not so long back, the focus was and our inclination was to have a cyclical audit wherein we would like to cover each and every aspect of the business in a cyclical manner. But over a period of time, this approach, and more particularly in the current environment, may not be suitable. And throughout this learning journey, we will delve into multiple aspects of this. My today's presentation, it is broadly divided into three parts. So we'll start with the background, then we move on to the risk-based planning process, and finally I'll share one practical example as to how to go about it. And throughout this presentation, I have also taken references from Institute of Chartered Accountants Standard or Internal Audit. They are not mandatory as of now, but they are recommendatory. But I strongly advise you, to read them and, as far as feasible, embed them in your IA functions. Now, as our today's topic risk-based internal audit. This is a very key pillar of organization governance. And the fact is that it's because the overall resources within any organization are limited, and same is the case for the internal audit function. Also, as CA Preeti ji highlighted a bit, that the today's business environment is very, very complex. It's very uncertain. Things are changing very rapidly, and the change is the only constant, I would say. In this kind of environment, the overall risks are also changing very fast, and moreover, the risks are interconnected and they are also less predictable. We were able to predict risk few years back or maybe couple of decades back. It was easy to predict risk at a more accurate manner because the environment was not so constantly changing, but not so anymore. And again, the risks are quite interconnected. So take an example of a financial services institution or a bank, and because of some vulnerability in their tech systems or information security systems, there is a huge data breach. The data of millions of their customers is lost. The servers are shut down. Customers are not able to access. So it has got multiple implications in terms of, it has got a client impact. Client cannot access it. It has got a reputational impact, and regulator may also have an oversight over these aspects, and you may have a regulatory impact as well. Now, before we now let me share my screen. Okay. CRTG visible? Okay, fair enough. Okay. Now, before we get into the concept of risk-based internal auditing, we will start with some of the building blocks. Take few seconds to go through the first thing. It's very, very straightforward. I'm sure most of us, would be uh, very closely associated with the internal audit activities and the function. So this is a very basic statement, but quite impactful. Internal audit provides independent assurance on the effectiveness of internal controls and risk management processes to enhance governance and achieve organizational objectives. This is picked up from the ICI framework, and I have highlighted a couple of aspects, underlined couple of aspects. So one is the independent. So definitely, the internal audit function need to be independent, and the independence needs to be achieved, one, from an organization and hierarchy perspective. Though in most of the organizations these days we see that the head of internal audit is reporting directly into the board and the audit committee. They may report into CFO or CEO of the company, but that should be more from an admin perspective so that their independence is not impaired. And also, as you know, that internal audit not only provides internal audit service, but internal audit also provides advisory services. Say, for example, within our organization, we also provide a lot of consulting services. Like, we have a lot of projects which are going on, or there is a big project going on. Now, rather than associating with that particular project at a later stage, it's a multi-year project, multi-million dollar project. It may take 2 or 3 years in implementation. Now, rather than doing an internal audit over what they have achieved after end of 2, 3 years, that will become a post-mortem exercise. In case something comes up or there are key risks which are highlighted, then it has to go through a proper change management process, and it will be again time consuming, and there will be cost implications. So in certain scenarios, we get associated with such projects on an ongoing basis. We see, what's happening, what are the key risks, how they are being mitigated on an ongoing basis throughout the journey of the project. Now, that also means that, we are party, we are party to the design and implementation stage of the project. So at that, in these kind of scenarios, the head of internal audit needs to ensure that the independence is appropriately managed. So we cannot audit something, which we have designed by ourselves. So need to follow with the guidance given by the ICI, or it may also be that, there may be segregation of duties. So person A has been part of project and person B from the internal audit function may be auditing it. So that's about the independence by the hierarchy and by the various products and services. Uh, Second is, internal controls and risk management. Again, not so long ago, the key focus of internal audit was to ensure compliance with laws and regulations, compliance with the policies and procedures of the organization, and it was more focused on the control assurance. It was like a control testing thing. But now the definition also includes risk management processes. So it's not only the internal controls which are implemented, but how the risk is being managed by the business. And it's more impactful and more imperative in those organizations which follow a three lines model. Even in other organizations as well, it's equally important, but it's very crystal clear in case of organizations which follow three lines model. So you have first line, which works along with the business, owns the risk, performs the risk assessment, and implements suitable controls to mitigate the risk. The second line, which is responsible for uh, developing the overall risk management processes, the various tools, and also provide oversight over the business over the risk management processes deployed by the first line. And of course, the internal audit, which comes at a as a third line as an independent function and is responsible for not only the adequacy and effectiveness of internal controls, but also the risk management processes, a more proactive approach which is there. Uh, And of course, the objective of all of this is to enhance governance and achieve organizational objectives. So governance in terms of, the overall relationship of the organization vis-a-vis various stakeholders. And it also includes, the compliance with laws and regulations of the land. Yeah. Okay. Uh, Next is this picked up from Standard Internal Audit 130, which talks about risk management. Risk definition. Risk can be defined as the probability of a threat exploiting vulnerability of business assets or processes or controls by occurrence of an event. You may have a look. There are too many things within it. And if you look at, the COSO framework or, the definition given by IIA or ICIA or, ISO 31000, there may be, some minor connotations here and there, some minor deviations. However, the overall theme remains the same, that risk is a function of impact and probability. And those are the two key things which are appearing in this definition as well. So I have highlighted probability and significant impact. Okay. With respect to impact, there is a separate slide for it and we can talk about it. But as of now, basically, what may go wrong, what could be the consequence to the organization in case something fails, and you can have multiple ways to put it, or there may be a matrix which may be put into picture, and we will see in subsequent slide. In terms of probability, again this is how probable is the risk. At each risk, it may have its own probability. Think of two different scenarios. Think of a earthquake. Now, earthquake may happen, once in 40 years, once in 50 years, once in 100 years, and definitely it's not a recurring thing. Uh, Within Earth, while assessing the earthquake risk, you also need to be mindful of, whether it's on platonic plate 3, 4, 5, because that will increase the probability of earthquake in that respective area. So that's one kind of risk. Another could be floods. Third could be, cyber attack, or it could be, more simple operational error. So a transaction or a payment was given to a bank and bank made an error in making that particular payment. So that of course will be, happening more frequently. So you need to have adequate controls to mitigate both those two risks according to their nature. Uh, Also, one thing would like to highlight that the risk, the moment we hear the word risk, it is interpreted in a very negative connotation. However, that may not be the case. Like in case of a trading firm or investment management firm, a trader may be asked to execute a trade which is more than the approved limits, but fortunately, unfortunately, due to the markets moving in reverse direction, we may end up in a positive cash flow. Isn't it a risk event? It's a risk event because the trader didn't follow the laid down process, or the controls failed and he was able to execute more than the approved order. But despite being a risk event, it ended up in a positive cash flow or a positive outcome. Yeah. In addition, in a risk event or in a risk assessment for a particular function, there are a lot of criteria, which we may be mindful of. Say, for example, velocity is one such example. It's the speed at which, the risk needs to be, mitigated or even need to be mitigated. Say, for example, you will have a incorrect payment being made to a vendor. So you will engage with the vendor, the organization will engage with the vendor, the organization will, you know, uh, uh, you do the needful, to sort out the issue, and that can be done, on a slow pace mode. However, if there is another risk event, say for example, fire in server room, then of course the response needs to be pretty quick. Next is frequency. So frequency, I think we just discussed, in terms of earthquake or an operational error. Now, next is, it could be volatility. So, say for example, there are certain things wherein, the overall risk changes and over a period of time. Think of commodity prices. So, commodity runs in a cycle and, it may keep on moving in either directions. Then, interdependence. I briefly touched upon it in the beginning when I gave an example of cybersecurity breach. Now, few months back, there was a low-cost airline in India which was there all over the news for wrong reasons because of rising oil prices and their squeezed cash flows and squeezed liquidity position. They were not able to spend much on maintenance and repair operations, and it led to a lot of mid-air incidents. Ultimately, it further impacted their reputation, further impacted future ticket bookings and revenue flowing in, and again it went into a vicious cycle. So all these risks sometimes may be interdependent. In terms of persistence, so how long, if something happens, something goes wrong, then how long will it take to be resolved? Like Russia-Ukraine war, definitely it would have disrupted the supply chain for multiple aspects. I think India imports a lot of oil from edible oil from Ukraine, so that got impacted, and it's ongoing for more than 2 years. Or during the COVID times, we saw that there was a huge shortage of uh, semiconductor chips, which impacted the hardware industry and the automobile industry. Uh, Another factor which needs to be considered is, controllability. What is within the control of the organization and what sits outside the remit or basically domain of the organization. So if it is an internal risk event, like we spoke about, the a trader being able to execute more than the approved order, so that is something which can be mitigated by putting in additional controls or strengthening the controls. Vis-a-vis, say for example, the central bank increases the rates, and it has got a direct impact onto the bond yields. Now that is outside the remit of something which cannot be controlled. Okay. Now these are various kinds of risks. And as per footnote, this is just an indicative list. It's not exhaustive. If you look at any typical bank or financial services, their risk taxonomy, it may easily run into 100, line items. It depends on, how do you want to define it, at what granularity you want to define the risks. So if we talk about some of these, high level risks like operational delivery. So if you it for any industry, say for example, it's a bank, then for them it's the daily operations they may define. There may be slippages, into the client life cycle or customer life cycle at the stage of account opening, or whenever you are making any changes into your account or into the payments. Statutory compliances, again, it's very straightforward. However, I believe there are, typically three I's in statutory compliances. So it starts with identification, then the next step is interpretation, and third is implementation. So you have identified it correctly, fair enough. You have interpreted it correctly, fair enough. But you may have messed up with it while implementing it into your systems, or basically, educating your staff. Uh, Say for example, recently, there was a lot of hue and cry with respect to indexation in capital gains. The government rolled back it, but now in the updated version, there are a lot of ifs and buts in, whether indexation will be allowed in certain scenarios, and in certain scenarios it's not allowed. So it's identified. We know this, or the organization which needs to implement these kind of aspects, say for example, any asset manager or any brokers, which provides, the calculation of capital gains and all of that. So they've identified it, they've interpreted it, but they might fail to implement it into their systems. uh, so that so hence, I talk about those three eyes within it. Now, financial reporting, I think we all are CAs, so I will skip that. BCP, business continuity planning and disaster recovery. So again, I take example of a bank. It need to be up 24 by 7, and that too across all channels. Point of sales for your debit and credit cards, internet banking, mobile banking, and branches as and when they are operational during the daytime working hours. Information security, data privacy. Again, I'll skip this. Technology, again, I think it's very simple. Human capital is very simple. Model may not be applicable for all the industries, but like, think of insurance industry, for example. So think of, some modeling error in the model, which basically takes into account hundreds odd attributes, and actually finally, calculates what should be the premium or those kind of stuff. So if something goes wrong, it can create liquidity issues for the insurance company, and so on and so forth. Supply chain, again, pretty straightforward, and geopolitical also, it's very, very straightforward. uh, Financial, I think, credit, we know, counterparty is also pretty clear. Liquidity, I take example, from financial services. uh, During the COVID period, when there was a huge market meltdown, you saw in news there were certain mutual funds in India which basically put a ban onto redemptions, or basically the customers were not allowed to sell off their mutual funds, because it would have been not feasible for them to honor all the redemptions and pay back to their customers. Market risk is, I think, pretty easy. Uh, with respect to strategic risk, we spoke that the environment is very, very complex. It's changing very fast. There are a lot of disruptions which are happening across in all the industries. Like, we take example of, Jiroda and Navi. So there has been hundreds of brokers in the country operating for last so many decades. But then, Jiroda, Navi, they have made their mark in last few years only, and they are super profitable. Or if I take example from, mutual fund, there are a lot of robo advisors, which are basically fintech platforms, which Navi is one of them, like, which basically allows you to trade on to them, and they are very low cost. So They are riding on technology, and that's a big threat to some of the established players in the market. In fact, we are also seeing, banks as well. I heard there was a bank. It is a branchless bank. It got opened in South Korea, and it's working pretty good. Uh, or things like, if I take example of electric vehicles, then it has got very less moving parts as compared to internal combustion engines. Now, if it has got less moving parts, less wear and tear, less need for lubrication, and hence impact on auto ancillary industry, which manufactures lubricants. So all of these things, different kind of risk, they need to be considered, and it's a whole lot of risk, whole lot of things to be considered. And the businesses are also very complex. The businesses are also, in case of large companies, they are very widespread, spread across multiple countries, multiple legal entities, multiple products, multiple channels. So a lot of things which an internal audit head need to be mindful of. So, and hence, the only answer is the risk-based internal audit process. Uh, Also, I worked in telecom industry, so I'll give an example, another example, from telecom industry. That think of the internal audit function within a telecom industry. In last 20 years or so, the overall risk profile also keeps on changing in line with emerging products. So initially it was all voice. We were making phone calls. Later on, the some revenue from messages got added. Then, I think in around 2005, 2010, they launched various value-added services. You remember those caller ringback tones and, astrology and those kind of stuff. And then it shifted on to, the data. And these days, content is the overall game. So all of these things require you to be one step ahead, move in line with the business overall strategic objectives, and formulate your internal audit plan and do the overall internal audits in line with that to help organization achieve the strategic objectives. Okay. Uh, this I picked up. I mentioned the source, and this is a very, a typical example. Different organizations may formulate it of their own, depending on their uh, specific scenarios. And there is no one size fits all kind of approach to have this kind of risk metrics. But this is very important, more particularly, I would say, to have a common ground across the organization so that all the risks which are emanating either by the internal audit reports or by third party reviews or audits, or raised by the business themselves, or maybe first line, second line, etc., they are all evaluated with a common scale. And as you can see, there are multiple parameters to it. So cost, of course, it comes, it's very important and very uh, inevitable. It could also be, the number of customers. It's not there over here, but as I said, it's just an example. So, like, in a bank or financial services, we may see that, it may be a low risk if something goes wrong and it's gonna impact, let's say, 500 customers. But it is high if it is gonna impact more than 500, but let's say, less than 50,000 customers. And it's high because it is going to impact more than 50,000 customers and severe and major and all of that. Yeah. uh, One practical problem I would like to share, and there is no specific answer to it. So many times you may see that organization would have one risk impact matrix. Definitely it have to be one organization was one risk impact matrix. Now think of an MNC. Now, it's more about the materiality kind of thing, and more from the cost and the profit and loss thing. Now, think of, let's say, Tesla or any other farm company. So within their risk impact matrix, $1 million may not be a big amount, but because they are looking at it from the overall entity at a global level. But now, when you are auditing it within a India specific legal entity, and you found something which is pretty big actually, but given the size and scale of specific India entity, the overall impact may not be more than $1 million, or it's just around $1 million. You would be very much inclined to rate it, at a high kind of thing. $1 million, it's a big amount, but given the overall organization-wide risk impact matrix, it has to be rated low. And herein, of course, you need to align with the organization risk impact matrix, and you need to be driven by that. And your resources and your overall, audit procedures and your overall, follow-ups and everything need to be driven by that. So it basically helps you, channelize your resources. So yeah. Okay. So I'll pause here for a few seconds, and I request you to, read the first four lines, and more particularly the four underlying items. This definition picked up from ICI Basic Principles of Internal Audit, and it is very beautifully articulated. And there is nothing, which I would like to add over here. It's crystal clear. It says you need to identify the important audit areas through a risk assessment exercise. I'll talk in subsequent slides about risk assessment, and I'll also give a example. Uh, then the second is the detailed audit procedures are prioritized and conducted over high risk areas. Simple. And less time is devoted to low risk areas, basically coverage of low risk areas through curtailed audit procedures. So it says you need to tailor it and detailed procedures for high risk areas and curtailed audit procedures for low risk areas. It's important because it helps you, remain focused onto the key and most strategic objectives of the company. It has got three objectives as per the standard, basically. Uh, you need not cover the whole process, and you can focus on your focus your resources or focus your bandwidth only onto the most important controls. So you may be auditing a particular process. You may identify four or five key controls over there, but four or five controls. But given the overall objectives, you may feel that only two are key and rest three are uh, additional or not so key, depending on the rationale and depending on the overall context. So you may proceed only with those two controls and need not spend and waste time on all the providing coverage over all the remaining three areas. Uh, establish linkages, second aspect, establish linkages to the aspects which are relevant and connected with company and functional objectives. Of course, that remains our primary motto. And third is findings and issues highlighted as significant or important. So they have the standard has used the word significant and important, but basically the idea is that whatever we say high, medium, low, severe, major, whatever is the terminology which is being used, but basically only the high risk areas and high risk observations are being highlighted. Stakeholders are also pretty busy; they have a lot to manage, and they expect us, to provide a very concise summary. They would not like to spend time on, petty issues. Yeah. Okay. Okay. Uh, in terms of, the overall risk-based internal audit, uh, there are objectives which are given over here, but in addition, uh, one and foremost is resource limitation. We cannot audit each and everything. There are expectations from regulators. So there are areas, and I work in a global organization. I see there are areas or there are geographies wherein the respective regulators, they expect internal audit to do some activities. So that again, which may not be material at times. So that may also be a drain. Sometimes they may expect you to do a whole lot of stuff or focus on, very meaty things. So that's why, you need to focus on the risk-based areas. And stakeholders, they also expect a lot of uh, stuff and value add from the internal auditors. And thankfully, we as an internal audit function or, part of third line, we are in a very good position. I always feel that, as an internal auditor, we, other than CEO, the internal auditor, is in a very good position to have a bird's eye view over the entire organization. So we have access to all the areas, we have access to all the personnel, and we are very uniquely positioned, to expand our role expectations and add value to the business. Uh, Also, if you would have noticed, I mean, initially, the beginning of the presentation, so this picture. So all of you would have played this game, the game of Jenga. You have got fixed blocks, and your overall task is to keep building a very high tower, as high as you can. You need to keep on moving one block at a time, and then keep it putting on the top. Now, if you draw an analogy to it, the objective of the organization or the game is that you need to build a high tower. And if I draw an analogy, to removing the blocks, so basically that's a drain onto your resources. So where do you sorry, spend your resources? Yeah. Okay. Uh, this is again from the standards and pretty straightforward. Management has identified, assessed, and responded to risk in line with the organization risk appetite. So herein, the focus is not on onto the internal audit. Herein, we are talking about the risk management framework which has been deployed by the organization. If it is a three lines model, it's pretty easy. If not, then of course, again, the fact remains the same that business owns the risk and they are best placed to deploy the risk management framework. So they need to identify what all risk they are exposed to. They need to assess the risk a lot, which we discussed previously, and then they need to think of the solutions or controls which they want to put in place to mitigate those risks. Uh, Second is the responses to risk are effective but not excessive. So you can have as many controls as you want, but of course sometimes it always it comes with a cost. The overall duration of the transaction, it may get elongated, and you add a lot of fluff to the overall process. So for example, in banks, when you are making a payments from one account to another, not the internet banking UPI, it's very easy, but when you are making it over the over the bank counter, then the payment is reviewed and authorized by two people. So typical maker checker control, but you still may see that payments going wrong because of oversight, fat finger errors, or whatever. So that can be managed. You can have another person to see it. You can have a six-eye check rather than a four-eye check, but I think that will be too excessive. So it's like a cost benefit analysis which management need to put in place. Actions are being taken for residual risk. So, starting with the first statement, wherein management has identified, assessed, and responded. Despite all of it, and the video which we saw, so risk can only be mitigated, it cannot be eliminated. So, despite putting in the best of the controls and solutions, there may be some residual risk. And after the assessment, management need to see that whether they need to take an action with respect to that residual risk or not. It may, if it is within their risk appetite, it's fine. You don't need to take any action. But if it is outside your risk appetite, you should frame any actions. And when we talk about actions, it also means risk acceptance. Sometimes, you want to live with a risk, right? Uh, you would have seen on, airline booking sites and all. So, or, these travel portals, when you make a booking, they give you an optional thing, to book your, um, to add on, the insurance as well. And the statement is very nicely written. It always says, yes, I want. So if you don't want to opt it, the statement says, yes, I don't want the insurance cover, and I want to risk my travel. So that's how they word it. So that's my call, whether I want to do it or not. Risk management processes, we have discussed broadly effectiveness of response and completion of actions. So once everything is done, the management is happy that all the risks are identified, assessed, responded to. But then whatever controls and solution are put in place, they are at a point in time. So everything is fine, but you need to monitor whether on an ongoing basis the controls are being operating effectively. They are being operating in the same fashion as it was envisaged, and the controls are sustainable. And the last is, with respect to the overall reporting of the controls, risk and controls and actions. It's basically the management reporting. Okay. Uh, I'll only touch. So this is from the standard internal audit 220, conducting overall internal audit planning. We will not delve into it, but there are few aspects within it which talks about risk-based audit plan. And this particular standard is different from another, similarly sounding standard, planning and internal audit assignment. That's SIA 310. So herein we are talking about the overall internal audit plan, a periodic internal audit plan, let's say annual internal audit plan, and the other standard is, planning a individual internal audit report, or the process. Yeah. So herein I'll touch upon these three things which are highlighted in green color. So comprehensiveness encompasses entire entity. So while we talk about risk-based internal auditing, the first and foremost thing is we need to know the overall gamut of activities, or the we need to ensure the comprehensiveness of all the business aspects which needs to be audited. So basically my audit universe. And there are different ways and means. How do you want to define it? There is no one size fits all. It can be done, on the, uh, I mean, there would be building blocks to it. How do you want to build up your audit universe? And underneath the audit universe, there would be audit objects, something which you may like to, audit. It could be a particular process, it could be a particular department, it could be a legal entity, it could be a particular country. And as I said, there is no, one size fits all approach within it. So, but it's important so that you know that these are the 100 odd things which falls within the responsibility of my organization. Then only you need to apply risk-based parameters onto those 100 items to identify which are the key areas and wherein you should play your hands upon. Yeah. Directional in nature, it's already covered. Timing, beginning of the plan period. This is, of course, suggestive in the standards, beginning of the plan period. So typically, again, few years back, we were happy with annual audit plans, but I think even the speed of change, which is happening across all industries, an annual audit plan may not be sufficient. You need to, revisit your audit plans on a periodic basis. It may be 6 months, it may be 3 months, maybe 9 months, and whatever deems fit as per the risk profile of your organization, so that at any given point your audit plan reflects and focuses on the audits which has got the highest risk within it. Nothing much to cover over here. uh, just one thing, that the audit plan which is formulated by the internal audit, it need to align with the organization risk assessment, need to take cognizance of it. it need to take cognizance of it. I'll cover it in the immediate next slide. So we spoke about audit universe and within it audit objects. We perform a risk assessment. We start with a, let's say, 100 odd audit objects, which forms the audit universe of the organization. We perform risk assessment over each of these areas. Now, this risk assessment is for the audit objects. This risk assessment is different from the risk assessment which management has done. So management is following a risk management procedure. Management owns the business, runs the business, management owns the business, and they are identifying, assessing, and responding to the risk. Herein, in this line, we are saying that while we are formulating our internal audit plan or while we are adopting risk-based internal audit, we will be mindful of what management is saying. So a simple example is, let's say, there are two areas, unit one and unit two, and management has done a management has done a risk assessment. As per management understanding of the risk within unit one and unit two, management themselves feel that unit one is more risky for whatever reasons. So that's their assessment. That particular assessment will be one of the input when I'll be rating, unit one and unit two. And of course, there will be a lot more factors. So this is, my risk assessment. Uh, Now, once I know that I have got 100 odd audit objects which form my audit universe, I need to take a lot of things into considerations. These are lifted in the standard, but again, depending on the availability of data, depending on your organization, there may be, few other items as well. But these are very basic and very generic and industry agnostic. So I think it broadly, covers the picture. So knowledge of the business, very, very important. I need to know, what I am going to audit. I need to understand each and every aspect of those, not each and every, but I need to understand, the high level about each of those, 100 odd audit objects, what it is, what does it pertain to. So say, for example, if the audit object is driven by, the legal entity or the country, then I need to know, what's the revenue size, what's the size of the company, what's the size of the business in a particular country or in a legal entity we are talking about, what are the key risks within that particular area. And uh, say, if the audit universe is cut across products, then there would be different risk for each of the product channel. So there would be different risk, when I am selling online, and there will be different risk when I am selling, in a brick and mortar model. So same, for the bank, in case of payments, there would be different risk, when a payment is being executed via point of sale, like your credit and debit card, swapping machines, or when a payment is executed when you are doing via UPI or internet banking or via check payments. Management stakeholder discussions. It's and these key considerations which we use for risk assessment. These are a mix of uh, objective and subjective parameters. Management stakeholder discussions, very, very important. So management owns the business, so they know much better about each of their aspects. So while we are doing a risk assessment, important to speak with the respective stakeholders, respective management, and depending on the overall organization size, resources, you may like to speak not only with the senior management, but the middle level management, and sometimes even at a process level as well. Audit universe, of course, how big is your audit universe, how many audit objects, how widespread it is. Then independent overall, the risk-based planning exercise which you are doing as part of this risk assessment. Technology deployment. So like, you know, uh, you may see, say, for example, there is an organization which has grown inorganically and has acquired a lot of companies on the go, and the overall environment is still not consolidated. So there may be certain legal entities which still use, let's say, Tele, some use SAP, some use Oracle. So definitely, there would be different risk. Some may be using, uh, own systems. Some may be using, vendor developed off-the-shelf systems. In certain cases, the server or the applications may be hosted, on your premises. In certain cases, you might be using, the cloud services. uh, Sometimes, you may feel that in a particular audit object, my uh, application which is being used or the technology which is being used is very flaky. I get to see a high number of incident. It breaks down quite frequently. So that goes into your risk assessment. Resource availability, of course, goes without saying. Regulatory statutory expectations, I'll come to it. Uh, yeah, left is the things in um, black color. They are all, procedural aspects within the internal audit function. So I performed the risk assessment. Now, after the end of risk assessment, I know actually residual risk. So basically, this residual risk is pertaining to the audit object. So basically, now at the end of this assessment, I know that out of 100 audit objects which I started with, there are 20 which are high risks. Like, say, for example, information security. I mean, for a pretty long time, this will gonna be high risk on all internal audit plans and or basically, audit universe for almost all the organizations. So 20 are high risk, next 30 are, medium risk, and next 50 are low risk. Whatever nomenclature or whatever scale, your organization has adopted. That's one thing. Second thing is, I also get to know that apart from these audit objects, or basically, sorry, within these audit objects, let's say from Australia, I have a business in Australia as well. I have got two audit objects pertaining to it. They are, as per my risk assessment, they are marked as low, but there is a regulatory or statutory requirement from Australian authorities with respect to that business that you need to audit it. So despite those two audit objects being low rated, I mean, on a normal basis, had there not been any regulatory requirement, I would not have focused upon it. But in this scenario, since there is a regulatory requirement and I as an internal audit function need to comply with it, so that also is need to be considered for inclusion in the final periodic IA plan. And of course, management request. So again, management may feel that one of the audit object, irrespective of, high, medium, low, it could be anything, and it is not doing well. There are some issues. It may be attrition, it may be system failure, it may be, supply chain issues, it may be, issues by vendor or too many customer complaints, and they would like an independent exercise to be done. So all of these things are available to me. After the risk assessment, I am aware of residual risk, I am aware of regulatory statutory requirements, I am available of management requests. This will help me formulate my periodic internal audit plan, which will be a truly risk-based internal audit plan. Now, I know 20 were high risk. There was one management request. It could be anything, high, medium, low. And for two audit objects which were rated low, there is a regulatory requirement to audit it, let's say, on an annual basis. So I've got 23 to consider. Of course, regulatory requirement takes priority, then definitely management request. And then, I need to think of my resources, my disk, the various internal discussions with, the audit committee chair, any overrides which are required, and overall approvals, and we get to a duly approved risk-based internal audit plan. Yeah. Okay. So I spoke about an example. I'll take an industry agnostic example so that everyone can correlate to. Think of it as a high level audit universe within your organization. HR, one of the functions. So we may define HR at, let's say, level one. We are talking about, let's say, global MNC operating in multiple countries. So at level one, you may say HR. Um, Within HR, of course, you will have payroll, and at a level three, you may define it at a region wise. Then, of course, this is for Asia Pacific, Europe. Then again, uh, you may have line item. Level two, you may have talent acquisition. Now, it depends on scale and size, and it also depends on, how do you want to do it. It also depends on the organization structure within the talent acquisition team. So if it is good, would like to retain only one line item, wherein payroll is too big, so you may like to retain three line items, one for each function. It also depends on whether the processes are consolidated or not. So maybe each and the payroll is centralized and it's happening from one of the offshore service center in India, Philippines, or wherever. Then maybe you would like to have only one line item with respect to it. Talent development. Similarly, for technology, could be like within the security, you may talk about information security, we all know. You may talk about threat intelligence, you may talk about network security. So there are various ways and means, how you can formulate your audit universe, and how you can, divide and create your audit objects. And of course, herein you can mention the various countries within it, like you have mentioned North America, or let's say APEC. But you need to be mindful to ensure comprehensiveness, which was one of the aspect, whether we have covered all legal entities and all countries wherein we do business. So we might be doing business in 10 Asia Pacific countries. So you can say, yeah, I've got these countries. So, the payroll function for these countries, and within those countries, you may have multiple legal entities, is covered as part of this line item. Whether you would like to do the audit for this entire audit object in one go or not, that's a separate question. Yeah. Okay. This was about audit universe and audit objects. Second step is risk assessment. Multiple factors which we can take into account on an inherent risk factors, the control environment which is put in place. I can talk about, some of the things. One and foremost, uh, is alignment with organization risk assessment. I gave an example that so if the HR head says that I have got more issues in payroll in North America rather than APEC. APEC is more stable, but I'm facing a lot of challenges in North America, and this is as per their risk assessment. So definitely, you will rate it slightly higher, in terms of inherent risk factors. You will say that, sorry. So within those, in that will be one of the inherent risk factors. And as I said that these factors, inherent or control environment, these may be a mix of subjective and objective. So herein for North America, you may say that as per manage, this could be one aspect, that as per management assessment, the overall number of risks as per their risk assessment, or open risk or high residual risk, they are 30%, or 3 out of 10 or whatever. But in case of APEC, there are no high or medium residual risk, so all is stable. So you will rate it accordingly, and you may have different ways and means to populate it. Then risk events. Risk events, if each and every error or near miss is duly recorded into a centralized format within the organization, then it's a very good way and objective way to identify, where things are going wrong or where things are, working fine. So you may find that in the last 1 year, when or last 6 months, when you are doing the planning, you are not finding any issues in payroll in Europe. So that could be another factor. It could also be, risk events. It could be customer complaints. So, zero employee complaints, or, here it may have, nine. So definitely, it will go a little bit higher. Yeah. Audit issues. You may have audited APEC, you may find, a lot of audit issues which are still open, still not remediated. So that could be, your third factor. Uh, Compliance. In certain organization, more particularly in financial services, uh, and those which follow a three lines model. Sometimes the second line or the compliance, there are separate compliance team which are responsible for ensuring compliance with the regulatory requirements. So they also perform a lot of reviews, like in not only compliance but even the statutory one. Like many organizations, they have outsourced the contract labor law related compliances to an external consultant or a CA. So if you see that there are too many issues coming up, let's say in payroll itself, then or maybe network security or information security, you are relying on certain vendors and there are a lot of issues coming up over there, you may like to rate it bit higher. Risk assessment, we have spoken. We have spoken about the audit issues, compliance, system incidents. Now, as part of your understanding, discussions with the management, which is an ongoing basis. The example which I gave, that you acquired three companies, and one has got SAP, one has got Oracle, and one has got Tele, and they all have different risk profile. It's flaky, so that the organization in Japan, it has got SAP, but somehow there were issues in implementation and it's breaking down very frequently. So you will rate it slightly higher. Yeah. Attrition. So uh, like in 2021, you saw there were a lot of attrition, more particularly on the tech side in some of the niche skills, information security, cloud computing, those kind of stuff. So definitely, if there is a uh, high amount of attrition within a particular audit object or particular area, it's a red flag, because there may be a knowledge loss and things may not be as smooth. So that is also one factor which you may take into account. And of course, while doing all of this, using objective factors or subjective factors, you need to apply your professional judgment. Then another factor could be that you are going to implement, or you have implemented new systems or new processes, or there is a big change which is coming up in that particular area. So that for next few months or something, it will be on a hypercare mode kind of thing, and things may go wrong within it, and this particular audit object might need more attention. Yeah. Then organization structure. uh, it's large, to a large extent linked to, it's not large extent, but yeah, it's linked to attrition. So attrition is one thing, but sometimes there are too many changes happening in the organization structure. There's lack of clarity, things may fall in between the cracks. So more particularly, when you have a dual line reporting, those kind of stuff. So in that case, would you think that the overall organization structure within this particular area is robust enough, there is appropriate governance, there is appropriate oversight which is happening, then yeah, you rate it accordingly. Uh, then another thing could be, changes in regulatory requirements, or changes in, statutory requirements, or new law coming in. Like in India, we might see, the Data Protection Act, which may come into picture. So it will impact, payroll definitely. It will impact my information security. It may not impact some of my other, routine, let's say, admin related stuff or admin related audit objects. So I'll rate it higher for that particular period. And to remind, it's an ongoing basis and it's very dynamic. So depending on the frequency which you intend to choose, say 6 months, you would like to ensure the first thing, comprehensiveness of your audit universe, basically ensuring that it has got everything what your organization is doing, and every aspect is covered over here. And then on a 6 monthly basis, you basically speak with management, you take into account all these things which I spoke about, and come up with a score. You can have different ways and means to adopt a scoring. Inherent risk, the overall way, whatever scoring mechanism you use, it shows inherent. Then for with respect to, the control environment factors, robust governance, appropriate oversight, for certain areas you may have a quality checks, you may have a, third party vendor reviews which are being done. So those kind of aspects may strengthen the overall control environment in a particular area. The risk assessment done by management may also say that this particular process or audit object has got more automated controls, more robust controls. So that will be a positive thing on your control environment. Again, depending on the scoring, you will get a control and the final residual, which will tell me which of these areas are risky. Like out of 100, 20 will come up, this will come up, let's say, high, and North America may come up high because there are some issues, but APEC seems to be okay. Once all of that is done and I've taken into account the management request and regulatory and statutory requirements, I can come up with the internal audit plan for the organization, uh, which will, ensure that all the internal audit resources, they are judiciously used, and the overall internal audit function is adding value to the organization by focusing only on the key and material strategic objectives of the company. So that's all from my side today, and I'm happy to take any questions.
We don't have any questions, sir. We just have a request that can you share this risk assessment template?
Yeah, sure. I'll send it across to Arunji and Arti and they can further circulate it to the delegates. Yeah, I
Yes, sir.
can populate some more aspects within it so that it's more helpful.
Sure, sir. Thank you. If member has any question, they can put so we can discuss that question. I think we don't have any question. So we can go ahead with the vote of thanks. I, CA Kinjal Mirani, on behalf of Board of Internal Audit and Management Accounting, give my sincere thanks to CA Bharat Garg sir for giving such a wonderful insight on risk-based audit. It was a very nice session with good examples, with the nice video at the starting, which says that you can't eliminate risk, but we can it can be only mitigated. So it was a very wonderful session. Members have learned a lot of insight on the topic. So I would like to sincere thanks on behalf of the members and the team. Thank you so much, sir.
Thank you, CA Kinjalji. And it was an honor, to share my views with the members. And once again, I would like to thank, all the organizers, CA Artiji, Arunji, and the Board of Internal Audit Management Accounting, and our Honorable President and Vice President. Thank you, everyone.
Thank you, sir.
Okay, bye-bye.
Bye.